Now let's take a look at how you should prepare for a potential decline in stock prices. We have Harry Dent. He is in Miami. Dent is an economist and author with the HS Dent Foundation. He says now's the time to get out of all risky assets and instead put your cash in T-bills and certificates of deposit. Also with me here in the studio is economics editor for Bloomberg Businessweek. We've got Peter Coy. Harry Dent, explain why you think that the stock market rally will fizzle in January and why people ought to put their money into T-bills.
Well, you know, there's only one good leading indicator these days, and it's demographics. We've been using it for 20 years, and baby boomers were expanding spending into 2007. They're in a plateau phase, 2008 to 2011, and as we move into 2012, they're going to enter their decline phase where their kids have left the nest, they're saving for retirement, and they're not spending money. So the stimulus that has had very little effect thus far will have less effect. Now, the stock markets are just saying, well, you know, their stimulus is finally working. This stimulus is going to run out in the next few months on an 8 to 10 month lag on QE2, and the economy without stimulus is going to fall right back flat on its face again. That's what demographics say. That's what the biggest debt run up in history says.
Hey, Harry, this is Peter Coy. Just a question for you. What is so different about next year versus 2007, for example? It doesn't seem demographic trends tend to be really slow and gradual. Why would we see a big change from positive to negative?
Well, again, I mean, it's actually precise when people spend money. The peak in spending is age 46 for the average family in the United States. Baby boomers in peak numbers hit that in 2007. This was something we predicted 20 years ago, not just recently. But there is a plateau phase between 46 and 50 where the kids are getting out of the nest, you know, either leaving high school or college for the workforce. It's when those kids are fully after the nest, out of the nest from age 50 on, that people's spending dives. And I'm telling you, it goes straight down from age 50 to death. So baby boomers in the highest numbers are going to be in that decline phase starting around 2012. So you're right. It's not exact like it's going to happen January 12th or something like that. But it does say we had a 4-year kind of plateau from 68 to 72 before we saw a bigger crash the last time a generation peaked. So we're looking for that. We think the danger goes up. Now, also, Europe is clearly going into recession. And it's not an accident that the countries in the biggest problems have the weakest demographics in Southern Europe. So, again, demographics is something economists ignore, and they should be ignoring at their peril because it's the best long-term leading indicator.
Harry Dent, what about emerging markets? I mean, if we look at the demographics there, burgeoning middle class, better growth rates, why not look for stocks that are going to benefit from growth overseas?
Because, you know, they're drawn by the rest of the world. China and emerging markets, yes, they have good demographics going forward. Actually, China not so much. They have been growing faster, but they've had bigger bubbles. China's overexpanded more than any emerging country in history, with the government driving over 50% of GDP. Greatest bubble in the emerging world. As Europe and the United States slow down, 35% of China's economy, roughly, is exports, a lot of it to countries like us. So when we slow down, their exports slow down. Their growth machine slows down, and then all these emerging countries that have been feeding them energy materials slow down. Emerging markets have already underperformed this year, and China's been the best leading indicator. The fastest growth countries had the worst performing stock market since March of 2009 bottom. So China's been a leading divergence that says, no, this rally worldwide is not going to last.
Hey, Harry, efficient market theory would say that if something is very predictable, like a demographic change, that you would expect that the markets would anticipate that. If they saw problems ahead, they would sell now in advance of that problem. Why isn't that happening?
You guys hear?
All right. Well, I think you're talking about efficient market theory, right? The idea that everybody has this information. So why wouldn't you already have this big sell-off in stocks?
Yeah.
Well, clearly it hasn't happened yet, although it has happened in emerging markets such as Brazil. You're seeing declines there, 17, 18% year to date, although the U.S. stock market, so far the best performer among major stock markets, up about 5.5% if you measure the Dow Jones Industrial Average, unchanged for the S&P 500, although that doesn't take into account dividends.
I'm not a huge believer in efficient markets theory always getting everything right, but when something is so much out there that if it really is going to move the market, you would expect something that big would be anticipated and accounted for by traders.
One of the things that Harry mentions is demographics, and I just want to get your perspective, this idea that if you have the baby boom generation in the United States entering retirement, does this mean that they're going to sell stocks in order to pay the bills?
Well, you know, that was the theory, but the counter theory is that people don't sell, that work done at MIT by Jim Paterba, for example, who is one of the leading economists of retirement savings and so on, says that actually a lot of boomers hang on to their wealth for decades. They certainly don't start selling stuff off at age 65 because they know they're going to live to age 85 or something, and they can't afford to lose their nest egg.
Harry Dent, what about that? This idea that people actually will live longer, so they won't necessarily sell their stock holdings.
This is totally misunderstood by economists. The few that look at demographics don't understand. It's not about retirement. It is ultimately, it's about the peak in spending. People spend more money, buy bigger houses, get their kids through college to age 46, and then they stop spending. The stock market follows earnings. Baby boomers don't dump stocks at age 46, you're right, and they don't fully dump them at age 65. That's not what drives the stock market. So it is the earning and spending, and if you look back, and we've tracked this over the last century, the stock market long-term follows on a 46-year lag, basically the peak in spending, not retirement, and not whether people are investing in stocks or not. Stocks cannot go up without earnings.
Harry Dent, explain a little bit more about the spending pattern that you're seeing. Does this mean, for example, that we will see less spending on homes, less spending on whatever furnishings go into homes, so that those are the kinds of stocks to avoid?
Yeah, I mean, well, homes peak first. I mean, in literally 4 to 5 years, we picked the housing bubble burst way back in 2004 and 5. That peaks first. Then people get their kids through college and stuff, and then all the spending on cars and food and other things follows and furnishings. So this is a gradual pattern, but housing is a leading indicator, and housing's the most leveraged part. So our economy's been weaker and weaker ever since housing's peaked. But when people actually start spending less overall, and that comes from age 50 to death, and I'm telling you, we know this cold. This is something we can predict down to the decimal point on average, just like life insurance actuaries do. It's the only thing that will tell you when an economy is going to turn, because economies look good, just like Japan in the late 80s, just like the U.S. in the late 60s, until consumers stop spending. And there's no leading indicator for that that tells you anything unless you're looking at demographics. So again, last 4 years, we expected spending to slow, but now we expect it to slow more. This means government stimulus will work even less. And you got the Fed on hold for the last 6 months anyway, because the economy's been improving. So just when the economy looks good here, we expect by the second quarter for our economy to weaken again, just like it did in 2010 after QE1. It'll weaken on an 8 to 10 month lag from the end of QE2, and we're going to be right back diving again. And I think it's going to, by the time the Fed reacts, it's going to be too late.
Peter, your ETF hasn't done too well since its inception. Do you expect it to recover in 2012?
This ETF, I do not promote it to my newsletter subscribers or the public. It is for financial advisors that need to be invested and have downside protection. So it's targeted to basically cut out and protect people if we have a major downturn. And it did that this year, and that's what we're looking to do in next year. But a momentum model has done very poorly, like most hedge funds in the 2011, because it's just been a mosquito market. Up, down, news. I mean, no model can adjust that fast. So we're just looking to tread water there and protect people on the downside. But we don't encourage investors to get into our ETF on the growth side when we're in a bull market. We'd rather them be in stock sectors.
Peter, I want to put to you the idea that the economy in the United States might be improving. We got the pending home sales numbers this week, better than expected. Initial jobless claims, better than expected. Chicago manufacturing index, better than expected. Is it possible that the United States economy will do better relative to other economies around the world, and that will draw money in?
Well, Bloomberg News has a good story on exactly that today, saying that the U.S. economy will outperform that of Europe. And we see some of the developing markets not doing so well either. So the U.S., for a change, could actually be one of the stronger economies in the world. I don't say strong, I say stronger. But as you say, for investors, it's all a relative bet. So some of the money might go to the U.S. that would have gone to other countries.
Harry Dent, is that possible? Is it possible that on a relative basis you see capital flowing into the United States because they see the U.S. as a better bet than other economies around the world?
Yeah, well, it's flowing out of foreign bonds into U.S. Treasuries, it's flowing into U.S. stocks. We predicted this. We have leading indicators, and you've got QE2 hitting on a lag. The difference between the United States and Europe, we were stimulating when Europe wasn't. This is stimulus. This is not fundamental strength. This stimulus is going to wear out. We predicted that the fourth quarter would be much stronger than the third quarter, and this boom will probably last into the first quarter. We think by second quarter, QE2 wears off, all this thing that the U.S. is doing better wears off, and the baby boomers start start to kick into their decline phase. I think it's going to be a surprising downturn for the economy in an election year when most people would not expect it. So we predicted the current strength. We're saying it will not last. This is temporary.
All right, so Harry Dent, where should people put their money? You talk about T-bills, U.S. Treasuries. Where else?
Well, you know, if you get out on the risk curve, the next place is the U.S. dollar. People don't realize in the last crash, in a deflationary debt bubble crash, everything goes down. Commodities, gold, silver, you know, real estate, everything went down in 2008 except the U.S. dollar and U.S. Treasury bonds. So the U.S. dollar index, you can invest in UUP. It's an ETF. Now, for more aggressive investors, we say, look, if you made money being in stocks on the way up or in gold and commodities, you can bet on inverse funds and bet on them going down. You can buy the SH instead of the SPY. SPY bets on the S&P 500 going up. SH bets on it going down. I think the S&P 500 is going to go down 30 to 50% in 2012 alone, and I don't think that will be the bottom.
30 to 50% decline in the S&P 500 in 2012.
Much like we saw in 2000. Yeah, just like this is going to be a replay of 2008, early 2009 over the next year or two from our point of view.
Peter Coy, the idea that people would be getting into treasuries, all right, as a safe haven, as Harry Dent suggests, won't that be good for the U.S. government because it'll keep borrowing costs low?
That's been the case. The U.S. has incredibly low borrowing costs, and some of the people who are in favor of stimulus cite that as a reason. They say, if you're ever going to do infrastructure spending, if you're ever going to build those roads and bridges and other essential infrastructure, why not do it when you can borrow at historically low costs?
All right. I want to thank you very much, Peter Coy, economics editor of Bloomberg Businessweek, and Harry Dent joining us from the HS Dent Foundation in Miami.